Warm welcome to CA Raja classes and thank you so much for joining this mini and micro webinar. Before we get into the discussion, let me just take a couple of minutes to introduce myself. I am CA N Raja, a chartered accountant by qualification, a teacher and trainer by passion and teacher for 3 lakh plus students worldwide. I started my career as a banker with State Bank of India. Then after a period of 4 years, I got into CA practice. I had my practice for 7.5 years. But I realized my calling is teaching. I started focusing on teaching and training, and today with the blessings of God we have 3 lakh plus students worldwide. So now it's time for us to get into the session. In this section we'll talk about term loan appraisal. Term loan is the loan given for taking up some long-term projects. It can be like say setting up a factory or for purchase of plant and machinery. Okay, so these are all the loans which are generally given for the period let's say greater than 3 years. And depending upon the bank's policy, it can be in the range of up to 8 years. Some banks goes up to 10 years, and in case of infrastructure projects it goes even up to 20 or 25 years as the case may be. Okay, so when you put up a proposal for loan, especially for term loan, you will carry a synopsis or say executive summary capturing very vital details of that project. Okay, that's what we are going to see in this session. That is, first there will be something known as executive summary. That executive summary will capture what the proposal is, that is, what is the amount of term loan you are proposing, then for what purpose this loan is being taken. Okay, is it for acquiring land and constructing building, or is it for purchasing plant and machinery, is it for setting up a factory? What is the purpose? That gets captured here, and this is coming under executive summary, right? Then key parameters related to the project which are going to be taken up with the loan, term loan, will be captured here. That is, what is the cost of the project, what is the tenor of the loan, what is gross average DSCR, and what about the security margin. Okay, so these four will give the overall view, or let's say bird's eye view of a project. When it comes to cost of a project, how much of this project is funded by debt, how much is being funded by equity? That's what bankers are interested in knowing. I mean, the sanctioning authority is interested in knowing at the executive summary level. Okay, because we'll be talking about the cost of project in detail in the following stages, but in executive summary they are interested in knowing how much is going to come for this project from debt and how much from equity, and out of that debt how much they are proposing with your bank and how much they are proposing with other banks. Okay, so this is the loan they are asking for, and how the owner's contribution are coming in, that is how much is coming in the form of share capital. Okay, how much is coming from internal accruals. Then when you have these two information, automatically you can derive debt equity. So debt equity ratio should also be provided. So what is debt equity ratio? Basically the long term debt, it is basically the long term debt divided by the equity brought in for the project. Generally banks will keep a level like 2:1, that is, it should not go beyond 2:1. So 2:1 means 2/3 can be debt and 1/3 can be equity. That is, to summarize, 67% can be debt and 33% contribution should be in the form of equity. Okay, so that also gets captured at the executive summary level itself. So before going deeper into the project, sanctioning authority here they'll be able to frame an opinion. If they look at debt equity ratio as 2:1, and if they see that equity is 33% or more and it is coming fully in the form of share capital, okay, then they'll be happy. Why? Because internal accruals is a different game. And long-term debt to equity, the ratio 2:1 means there is a major contribution, or most of the contribution is coming from whom? Coming from the borrower, and only 1/3 is coming from the bank. It means borrower is assuming the majority of risk in this project, and bankers are going to get revenue out of this project because the major risk is borne by the borrower. Okay, so all those information will get captured here, and that will help the sanctioning authority to frame a overall picture of this borrower. Then tenor of the loan, whether tenor of the loan is within policy, because as I told you, it can be like for a period greater than 3 years, but let's say up to 8 years or up to 10 years, and infrastructure projects it can go up to 20 or 25 years as the case may be. So if the borrower is insisting on tenor greater than 8 years or greater than 10 years, then it is actually a deviation from the loan policy guidelines of the bank. So sanctioning authority will be interested in knowing whether this proposal comes with a deviation or without deviation, okay, to get a level of comfort. Then what is the moratorium they are asking for? Why moratorium is required? Because here term loans are used for creating assets, right? And those assets should generate revenue. That revenue will bring in profit, and from that profit, to put it rightly, the cash profit only, term loan can be serviced. But not all projects will start generating revenue from day one itself, because you have to borrow, you have to acquire assets, you have to install the assets, there will be settling down time period, teething issues, and it will take time for that asset to generate revenue, because it should cross what is known as break even period, and only after then it will start making profit. That profit can be used for servicing the loan. So they need some kind of a holiday. They need some kind of a holiday. Here bank may be agreeing for the holiday in terms of principal. Okay, bank may say, okay, take the loan for up to 6 months. You need not pay any principal, pay only interest. Pay only interest. It means here this is the moratorium, that is holiday, principal holiday period given to the borrower. Okay, so what is the moratorium? That should also be captured. Then sanctioning authority will be interested in knowing what is the gross average DSCR, because this is what going to measure ultimate repayment capacity. This is what going to measure ultimate repayment capacity. We'll be having dedicated sessions on gross average DSCR, but to put it simple, it is basically the cash accruals available for servicing the loan divided by repayment obligation, divided by repayment obligations. So when I say cash accruals, how this cash accruals is derived? It is basically profit after tax minus dividend plus depreciation plus interest on term loan. Please note, I am deducting dividend here because profit available after paying to the shareholders, only that should be taken, and that is added with depreciation being a non-cash item, and that is added with interest on term loan only. Interest on working capital is not taken into consideration, interest on term loan, and that is divided by repayment obligation, which is nothing but interest on term loan plus term loan principal installments. Okay, so when you divide this, you are going to get some number, and that's what we call as DSCR. So this is the DSCR for each and every year. So we call this as gross DSCR. It will be calculated for each and every year, and let's say the loan tenor is 8 years. Then what you will do, you will take the numerator for all the 8 years, you will also take the denominator for all the 8 years. So total of, let's say, 8 years numerator, total of 8 years denominator, you will arrive at a DSCR, and that DSCR is what we are going to call as gross average DSCR. Each and every bank will have certain level. In general, gross average DSCR is expected at around 1.75. Okay, some banks will go to the extent of 1.5, and even some private sector banks, they go even up to the level of 1.3, 1.10 and all. But 1.75 is the most conservative level. The reason being, you get 1.75 when your numerator is, let's say, 175 and denominator is 100. This is the level where you get 1.75. It means out of 175 you are going to use 100 for repaying principal and interest. It means you are left with 75. Why this 75 should be left?
This is required because this money should go as net working capital for supporting the working capital margin of the business. Okay, at the cost of term loan, you cannot compromise working capital margin. That's why banks prescribe levels like 1.75. Okay, next comes security margin. That is, sanctioning authority will be interested in knowing what will be the security margin, mainly the average security margin available throughout this loan period. Let's say the loan given is 50 and the assets available against this loan is 100. It means you have a security margin of 50. This is in year 1. In year 2, the asset value 100, because of depreciation it is becoming 90. Okay, and your term loan outstanding is also coming down. Let's say 50 is becoming 45. So what is the security margin you have now? 45. Now what I'm going to do, this is the security margin I had 50. 50 on 100. If I express in percentage, security margin is 50%. Here this 45 on 90. Luckily here also we are getting the same. 45 on 90, security margin is 50%. Let's say third year. This is becoming 85 and this is becoming 40. So 85 minus 40, you still have 45 as security margin. 45 on 85, this is greater than 50%. Like that you will be calculating for each and every year, and eventually you will be taking the average of this. That's what we capture here as average security margin. We capture that here as average security margin. So these are all the key parameters, and by looking at this, sanctioning authority will be able to get a overall picture of the key issues or key parameters of this project.
Thank you for watching this webinar. I am sure you have derived value from this webinar. And if you wish to learn more, I have some good opportunity for you. What is that? Check out.
It is this Credit and Financial Analysis Mastery course exclusively designed for bankers and for those who want to have bankers' point of view. This is a course which we have developed after a detailed analysis, a thorough discussion with several hundreds of bankers and finance professionals. We have identified what is their exact requirement when it comes to SME and corporate credit and financial analysis. In this mastery bundle, I'm going to give you access to various courses. To start with, we have course number 1, Basics of Credit Analysis. In this course, we have explained the basics of credit analysis through various sections, section 1 to 9. Next comes course number 2, that is how to read balance sheet. In this course, we have explained what is balance sheet, how to read them, how to approach them by using real life financial statements. Then comes course number 3, how to do financial ratio analysis like a banker. In this course, we have explained all critical ratios that are analyzed by the bankers, and we have also explained through case studies. Then we have course number 4, how to do cash flow analysis. So through this course you will understand what is cash flow analysis, how to do a typical cash flow analysis. We have used case studies, and reference to Ind AS is also included in this course. Then we have course number 5, that is how to do fund flow analysis. This is a critical financial analysis tool, and in this course you will learn what is fund flow statement, how to analyze them from banker's angle, how to prepare fund flow statement from academic angle as well. So overall 5 courses, each 1499. So aggregate price should be 7495, but you are not going to pay that. For you it's just rupees 2499 for 1 year access, or rupees 4999 for lifetime access. And it is not yet over, you have some more bonus. Bonus is course number 6, how to carry out credit risk rating for non-trading entities. These are all the topics covered in this course. Then course number 7, it is how to carry out credit risk rating for trading entities. Not yet over, you also have access to course number 8, that is how to prepare CMA report for bank loans. It's a comprehensive course which will run for 8 plus 5 hours, and you will learn entire CMA report preparation process. And course number 9, how to prepare cash budget for bank loans. Course number 10, how to assess fund-based working capital. So in this course, you will understand what is working capital, what are working capital credit facilities and how to assess them, what are the key ratios that are related to working capital, and what are the additional key analysis that will be done by bankers on working capital matters. You will get a comprehensive understanding of cash credit, export finance, and there are certain on-demand videos as well. So 5 plus 5, 10 courses of value close to 15,000 rupees, but you are going to get it for 1 year access rupees 2,499, lifetime access rupees 4,999. Not yet over. You are going to get access to the 11th course, how to assess non-fund based credit facility. So in this course you will learn about letter of credit, bank guarantee, its assessment as well. Then comes course number 12, how to do term loan appraisal and assessment, because it's a complex process with a lot many technicalities. So this course covers all in detail. And course number 13, basic elements of loan proposal. So how a typical loan proposal will be, what are the basic elements that are covered in this course. And we have course number 14, case study on credit analysis, various case studies based on practical experience and discussion with various bankers and finance professionals are included in this course. And course number 15, this is about collateral securities, where you get knowledge about collateral securities. So overall, it's 15 courses of value close to 22,485. It's 1,000 plus lectures. You can subscribe for 1 year access or lifetime access as you wish. These are all pre-recorded courses, so you can access them anytime as per your convenience. You can access them in mobile app or desktop, and for you the price is not 22,485, it is rather 2,499 for 1 year access or 4,999 for lifetime access. You can check the link in description, where without using any discount coupon code you can enroll at this discounted price because it's a discount applied link. And not yet over, you are also eligible for some more bonus. The bonus is access to various ebooks and e-resources. You are going to get access to various financial ratios ebooks, financial management related ebooks. You will get access to financial analysis related ebooks, credit analysis ebooks. Not yet over, you will also get access to other resources like test series, templates, audiobooks, video books, career guidance material, and a bonus resource. Check the link in description and enroll now.